On August 16th, the Fed funds futures curve implied a belief that there was an almost 60% probability that the Federal Reserve would hike rates by 50 basis points at their September 21st meeting. In 1 week's time, that probability has fallen to 45% chance of a 50 basis point hike and a 55% chance of 75. From a data standpoint, nothing has changed dramatically. We've seen some disappointing numbers out of the housing sector and a mixed retail sales number with a lower headline number but a higher number ex-auto and gas. What has changed, though, is our proximity to the highly anticipated Jackson Hole Conference, where Federal Reserve Chairman Jay Powell speaks on Friday, August 26. The market appears to fear a speech from the chairman that convinces the market that fighting inflation remains the #1 priority. Not surprisingly, two-year Treasury yields have moved higher in conjunction with expectations for a more aggressive Fed. The two-year yield has risen from 3.17% on the 16th to a current level of 3.34%. If a trader believes that two-year Treasury yields could continue higher, perhaps on a Friday speech that underscores an unwavering commitment to fighting inflation, they could express that by buying the August micro two-year Treasury yield futures contract at 3.33 and target a move to the psychological level of 3.50. A stop for this trade could be placed below at 3.20. This trade could make $170 if your target is reached and risks $130 if you're stopped out of your level. Now, if a trader believes that two-year yields could move lower from here, they could represent that by selling the August micro two-year Treasury yield futures contract at 3.33 and target a move to the early August low of 2.90. A stop for this trade could be placed above at 3.55. This trade could make $430 if your target is reached and risks $220 if you're stopped out at your level.